Welcome to the deep dive. Today, we're not just opening a history book, we are opening a forensic file.
That's a good way to put it.
Yeah, on one of the most just stunning financial heists and maybe the most blatant institutional betrayal in modern history.
Absolutely.
Our mission today is to investigate the 1980 Silver Squeeze. But we're framing this like a high-stakes casino movie, where the heroes almost break the bank and then the house just cheats to win.
It's a foundational story, really,
Yeah.
because it's not just about silver, it's about power. It basically exposes this uncomfortable truth that the markets aren't always what they seem.
How so?
Well, if you pose a real existential threat to the big players, they won't just try to outtrade you. They will literally rewrite the rules of the game to protect themselves.
And the hook here is it's unbelievable. In 1979, going into 1980, the price of silver just went ballistic.
Completely vertical.
It jumps from around $6 an ounce to a peak of $50. And if you adjust that $50 for inflation, I mean, that's nearly $200 an ounce in today's money. It was a move that almost broke the economy.
And it was all engineered by two men, Nelson Bunker Hunt and William Herbert Hunt, Texas oil barons.
And they weren't just investing. They were trying to do something called a market corner, right?
And that's it. They were trying to buy every single ounce of deliverable silver on the entire planet.
Which sounds, it sounds almost illegal, but the crazy part is what they did, just buying a product, was perfectly legal. The real crime, the manipulation we're investigating today, that came from the other side. When the big Wall Street banks were facing collapse, they didn't find more silver. They just changed the rules mid-game.
And that's why we have to talk about this. The mechanism they used back in 1980, it's the exact same power that's embedded in the system today. It is the playbook for market control.
Okay, so let's set the stage. The motive. You really have to get inside the mind of Bunker Hunt. We're in the 1970s.
Right. And the 70s were all about runaway inflation. The U.S. had just ditched the gold standard. There was this deep mistrust of paper money.
So what was the Hunt's big fear?
It was really simple. Currency debasement. Bunker Hunt was, famously skeptical of central banks, of government spending. He'd look at a dollar bill and just see a piece of paper that could be printed into worthlessness.
He had that incredible quote, $1 billion isn't what it used to be.
Can you imagine? Coming from a man who had several $1 billion, but that's how he thought. He wanted an asset that couldn't be inflated away, something he called something that couldn't be printed.
So why silver? Why not gold? That's the traditional safe haven, isn't it?
Gold was actually their first choice, but it was illegal for Americans to own physical gold until 1974.
Oh, didn't know that.
Yeah, and by the time that changed, they saw a better opportunity in silver. They realized silver was this kind of unique case. It was heavily used by industry, photography, electronics, you name it, but totally ignored by investors.
So there was a deficit, a physical deficit.
A massive one. And this is where the Hunts really separate themselves from, let's call it, the dumb money.
Okay.
See, most people trade on the COMEX, the commodities exchange using paper futures. They're just betting on the price. They never, ever want to see the actual metal.
They just want to settle for cash.
Exactly. The Hunts couldn't have cared less about the paper promises. Their strategy was all physical. When their contracts came due, they refused the cash. They said, no thank you, we'll take the metal.
And that move, that was the genius of it. That's what exposed the whole system.
It really was.
Wait, so you're telling me the banks were running a fractional reserve system for a physical commodity?
Just like a regular bank, yeah. They were selling way more promises for silver than they actually had in the vaults.
How is that even allowed?
Well, that's the nature of derivatives. For every 1 real ounce of silver sitting in a vault, they were happy to sell, maybe 20, 30, even 100 paper claims on that same ounce.
And the whole system only works as long as nobody asks for the actual stuff.
And the Hunts started asking on a massive scale. They were calling the bluff.
So this wasn't just them clicking buttons on a screen. This was a physical heist?
It was a huge logistics operation. They had to charter armored 747s,
Wow.
huge cargo planes, just to fly millions of ounces of silver out of New York and into private vaults in Switzerland. They were literally emptying the warehouses.
And the scale of this, they didn't do it alone, did they?
No, they partnered with Middle Eastern royalty.
Yeah.
That was partly to get around U.S. trading limits. It adds this whole geopolitical flavor to it.
So by late 79, how much did they have?
The Hunt Consortium controlled over 100 million ounces of physical silver. That was estimated to be about half of the entire world's deliverable supply.
They'd done it. They actually cornered the market.
So the corner is a success. The price hits $50. And this is where the counterattack begins. because when the Hunts won, someone else had to lose.
And who was on the losing side of that trade?
The big Wall Street banks and brokerages,
Hmm.
they were the ones who were massively short the market.
Right. For anyone new to this, being short means you've sold something you don't own, betting the price will fall.
Exactly. The banks were the biggest short sellers. They had flooded the market with paper contracts, assuming the price would stay low forever. When it hit $50, they were facing billions in losses,
Billions with a B.
enough to threaten the collapse of major firms. We're talking about household names on Wall Street.
So COMEX, the exchange that's supposed to ensure a fair market, is now facing an existential crisis because of its own members' bad bets.
That's the irony. So what do? They call an emergency board meeting.
And let me guess who was on that board.
The very people who were losing all the money. It was the shorts calling a meeting to figure out how to save themselves.
And what came out of that meeting on January 21st, 1980. This is the moment the story turns from a market drama into a conspiracy thriller.
They passed something called Silver Rule 7.
Silver Rule 7.
It was unprecedented. A unilateral, immediate rule change designed for one purpose: to crush the Hunts.
Okay, let's let the gravity of this sink in. What did Rule 7 actually say?
Effective immediately, all trading in silver futures was for liquidation only.
Liquidation only. Just stop and think about that phrase.
It's chilling.
You could legally sell your silver contracts, but you were illegally banned from buying any new ones.
The effect was instant. It was brutal. The entire demand side of the equation was just erased by decree.
It's like you own a warehouse full of apples and you're rich because everyone wants to buy apples. Then the government steps in and says, from now on, nobody's allowed to buy apples. You can only return them.
Your asset is now worthless. The price is guaranteed to crash no matter how few apples are left in the world. It was pure self-serving market manipulation by the regulators themselves.
And they had another weapon in their back pocket, too, the margin call.
Oh yeah, that was the other shoe dropping. They dramatically jacked up the margin requirements.
Margin being the collateral you have to post.
Right. So they went to the Hunts and basically said, congratulations on winning. Now, to keep your winning positions open, you owe us $100 million in cash by tomorrow.
That's the checkmate. The Hunts had all the silver in the world, but they didn't have the liquid cash.
They were asset-rich, cash-poor. And because of Rule 7, they couldn't even sell a little bit of their silver to raise the cash for the margin call.
Because buying was illegal.
The trap was sprung. They were forced to sell into a market where there were legally no buyers.
And that brings us to the climax of this whole thing. Silver Thursday, March 27, 1980.
It was absolute chaos, pandemonium. The Hunts couldn't meet the margin calls, and they had no choice but to dump everything.
And the price
Plummeted. From that peak of $50 just weeks before, it crashed to below $11 an ounce. They lost over $1 billion, almost overnight.
And then, to add insult to injury, they were immediately turned into the villains of the story, dragged before Congress.
Painted as greedy manipulators who tried to hurt the American consumer.
But the forensic verdict, when you look at the actual facts, it's the complete opposite, isn't it?
The Hunts were only guilty of one thing: buying a product and causing the price to go up. That's called a free market. The exchange, the house, they're the ones who manipulated the price down by banning buyers.
It sounds horrifyingly familiar. It's exactly what we saw happen with GameStop and other meme stocks, right? When the hedge funds were losing, the retail brokerages just turned off the buy button.
The playbook never changes.
Yeah.
When the house is losing, they change the rules. It's the ultimate lesson of these paper markets. The Hunts prove that you don't actually own the asset.
You own a claim on the asset.
And that claim can be rendered worthless by a committee vote. It completely destroyed the silver market for decades because it sent a message. If you try this again, we won't find metal for you. We'll just change the rules on you.
Okay, so let's bring this to today. Why does this 40-year-old story matter so much in 2026?
Because the fundamental structure of the market hasn't changed. In fact, you could argue it's gotten exponentially worse. That fractional reserve system is now hyper-leveraged.
Let's talk scale. Back then, the ratio of paper claims to physical silver was maybe, what, 20 to 1?
Something like that. Maybe a bit more.
Yeah.
Today, the estimated ratio of paper-silver contracts to actual physical deliverable silver is thought to be close to 200 to 1.
200 to 1. That's insane.
The banks are still massively short, and the physical inventory in the Western vaults is just critically low.
So if the leverage is 10 times worse, why hasn't it broken already?
Because they've managed to keep the game contained within their own rules, the COMEX and London rules. The system works as long as nobody big ever really asks for the physical metal. But there's a new player now, a game changer the Hunts didn't have,
And that is
the Shanghai Gold Exchange, the SGE.
the rise of the East. How does a Chinese exchange change the game for silver in New York?
It's simple. The COMEX is a paper exchange. The SGE is a physical exchange. Meaning, when you buy a contract in Shanghai, you get the metal, period. Physical delivery is a fundamental rule, not an annoying exception. They don't play the same fractional reserve game.
And there's this global arbitrage happening where the physical metal is draining from west to east.
Constantly. Every single day. The West is basically shipping its real physical metal to the East in exchange for paper currency. It's systematically emptying the very vaults the COMEX would need to deliver from.
So let's play this out. A new Hunt brother appears. Not two cowboys this time. Maybe it's a sovereign nation or a tech giant that needs silver for AI chips.
Right.
And they start demanding physical delivery from COMEX. What happens?
Well, they could try to pull a Silver Rule 7 again. They could ban buying.
Yeah.
But this time, the metal isn't there to sell, even if they wanted to. It's already gone. It's in a vault in Shanghai, outside of their rules, outside of their reach. You can ban buying all you want, but you can't change the physical reality that your inventory is zero.
So the Hunt brothers were just 40 years too early.
Their strategy was perfect.
Yeah.
Buy the physical. But the game was rigged. The next squeeze won't be cornered by two individuals you can demonize in Congress. It'll be cornered by simple geopolitical economic reality.
It's not manipulation at that point.
It's just math. When the ratio is 200 to 1 and the physical asset is leaving the building, the paper market will eventually break. It has to.
So the deep dive today, what does this all mean for you? I think the central finding is pretty stark.
It is.
The market is not some free and fair arena when the big institutions are losing. They have the power to just change the rules of the game to make sure they survive.
And that leads to the final, really critical thought here. It's about what ownership even means. The future belongs to the people who own hard assets, things that can't be just legislated out of existence by a board vote.
So here's the provocative thought to leave you with. Given what they did with Rule 7, if the COMEX faced a total collapse today, what new, even more unprecedented rule might they invent to save themselves this time? And more importantly, how would you prepare your own assets for that kind of event?
That's the question, isn't it? It gets to the very core of what it means to own something. Is it a physical reality, or is it just a promise that can be broken?